Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we have a great show for you again today. It's Wednesday, July 9th, 2025. We're coming to you live at 5 p.m. Eastern, as we do every Wednesday. So if you are watching this live on YouTube, or if you're watching this after the fact, you can always like and subscribe that. It certainly does help us out, get our content noticed by more and more people. And this is a great one to be noticing because we've got Mish Schneider coming back on the show. She, of course, is a chief market strategist with MarketGauge, and she's been on a number of times. So welcome back to the show, Mish.
So great to be here. Thank you for having me back.
Absolutely. And one of the things, we'll just get right into it, because one of the things that you've kind of popularized is the idea of a modern family to kind of make your way through some of these macroeconomic factors and make sense of what's going on. So maybe you could give us an update on some of your family members that are maybe acting a little bit better than they typically do, and maybe some of the ones that are maybe needing a timeout.
Well, what's interesting right now is the Modern Family was a creation that I did many, many years ago to simplify the complexities
Right.
of the macro, right? Because it is really hard to explain, especially now where it's even more complex than it's ever been because the headlines are so fast and furious. But the nature of the Modern Family was US centric. And that's important because right now, obviously, the whole administration is geared towards bringing things back to America, right? That's the whole point of the tariffs, the big beautiful bill, and everything that President Trump is doing, trying to rebuild America, so to speak. And so that Modern Family is going to be the place that you're going to go to find out if it's working, right? So if semiconductors are part, I call her sister semiconductors, Wonder Woman right now, because we can see that that broke out and has not looked back once again. The rally has been extraordinary. It's leading, growth is leading. NVIDIA got to 4 trillion today as a company. Obviously, that's one of the top stocks there. But of course, it really speaks to the whole AI movement. It speaks to robotics and space and everything else that really is the future. But the big question, of course, is it's leading at this point, and it has certainly led the rest of the market up. Can it continue to lead? Or at what point does it have to look back at the rest of the family? And Justin, we have seen this over and over where growth marches on, marches on, marches on, like in 2024, and then at some point looks back and notices that the rest of the economy isn't exactly following, and that's when you get these massive corrections. So that's number one. Secondly, of course, would be, okay, so what are the inside sectors? There were 3 parts of my family that actually Stanley Druckenmiller coined the phrase inside sectors. And we don't know each other, by the way. It just happened to be a coincidence, a happy coincidence. And he called transportation, small caps, and retail as the inside sectors. Why are they the inside sectors? Because that's really you're going to see. That's the real gauge, the barometer of what the U.S. economy is doing outside of growth. And what's so interesting is a lot of people came into this year like super bullish small caps, and they've certainly gone up and they've done okay, but they're not near their all-time highs yet. They're still a good percentage away. Not that bad, but they're still a good percentage away. And you have to consider that when S&P 500 and NASDAQ and semiconductors and the Dow all make new all-time highs, you have to say what's wrong. So that's where your industrials are, your manufacturing. That's where you're really going to be able to see if these companies that have manufacturing outside of the U.S. and are tariffed now start to have a bigger presence in the U.S. or it incentivizes other companies to have a presence in the U.S., the smaller capitalized companies. So far, the answer is maybe. The second one, of course, is transportation, if you want to put up IYT there. And that's actually also not doing so badly, but again, kind of like the Russells, not doing so badly, being dragged up with growth. But is it really leading to show that things are moving robustly, goods and services? That's what it is. Planes, trains, and automobiles, if you will. And again, we're looking at IYT now, and you can see we're not near the all-time highs, but we're not too far. So again, we can say, is it working where we're starting to see more robust movement? maybe outside of some of the travel, because we know that some of the travel has been impeded by a lot of tourists not coming here that were before. It doesn't seem to be that bad of a thing. So you look at that, you look at the moving average, you have to say, maybe, right? We're still in maybe, two maybes.
Well,
we got a yes.
And with
Go
with
ahead.
IYT, I would almost wonder a little bit because Uber is it's like either a 20% or 25%. It's the heaviest weight by far in that, and Uber looks very different from, let's say, your
FedEx. Put up
your Union
FedEx.
Pacific,
Right.
or
Well, yeah,
something
look
like
at that. Right. Or put up, even FedEx or UPS or any of the freight companies.
Yes.
Right. I mean, right. So Uber is carrying it, and that's a really good point, Justin. Excellent point, actually. Because when you look at a basket of an ETF, you have to look at the more heavily weighted ones. And in this case, Uber is keeping this up, but is that enough to sustain? It's the same question as can growth in semis sustain? This is what we don't know yet. And that's why I hate to make a prediction about where things are going. I think we'll know very quickly whether these things can really move up higher or they get tired and everything else starts to come off and we have yet another correction. I'm not talking doomsday or anything. I'm just talking about maybe another 10 to 20% correction at some point. It's possible. Okay,
Right.
The last one to show in the inside sectors I think is the most important, and that's, I love to call her Granny Retail, named actually after my own grandmother, who didn't walk very well until she went shopping. Then all of a sudden the cane got flung
a spring in her step.
Right, yeah, she loved to shop. And so if you look at Granny, that's a deceptive chart because she peaked in 2021. Why? Because everybody was home, online shopping with their stimulus money. And since then, we've seen a lot of the economic statistics really give this somewhat of an impediment, from the fear of tariffs, the fear of inflation, wages going down, labor markets shifting to more maybe potentially automative in a lot of the industries. Before the show, we were talking about the fact that Microsoft saved $500 million in not having to use labor because they could use AI. That's the stress of Granny right now. Now, it's still doing okay, but it's about 30% away from the all-time highs, which means maybe 25% at this point, which means that that's a whole lot of confidence we have to see in the consumer to come back and really get this U.S. economy humming.
Yeah. I also want to go back to the small caps real quick, because one of the things that seemed to come up a lot last year was all of these attempts. It seemed like it just kept on trying to break out, but it would only last a few weeks and then boom, right back into a base, break out, and then and it wouldn't just come down. It would sometimes fail spectacularly. And then of course we had this 30% correction in the Russell 2000, the small caps, as tariffs reared their ugly head in those fears. Do you think it's finally maybe they can come back? It's been one of those areas that people have been saying for, I feel like, a couple years. Oh yeah, it's small caps' turn, but they never seem to keep their turn for very long.
Right. It's the same argument as value versus growth. Oh, value is going to be the thing this year, and guess what? It's still not. And so there you go. Right. This is exactly what we're talking about. Is if we want to see a sustained rally, it doesn't mean that small caps have to lead, but they can't do one of those massive corrections that you were just referring to again, because it will drag everything down. And so at this point, if you're looking at an area that has to hold, I would say it kind of tested 215 as a number for IWM. I would look at that number as a really important number. 225, which it kind of is sitting around right now, would be a good breakout area. But we still got some work. Look at the all-time highs. They were up at 244, and we're trading at 222. So that's a nice little move. It's got to go all-time highs. Now, does it have to go to all-time highs to keep the party going in the rest of the market, particularly growth? No, but it definitely has to stay in the game. Now, it does look like a nice double bottom there that you put in with your green little ellipses. So it is also possible that we just have to be more patient.
Hmm. No, absolutely. And just kind of talking about again on the macro side, of course, the dollar and the treasuries, are two things that a lot of folks are watching, and of course, a lot of that trickles down to the the commodities themselves, which we will talk about in a little bit. But let's maybe just start with the treasuries. And I'm going to go ahead and show a chart that you brought with some of your indicators. This is on TradingView. So TradingView does have some of the market surge indicator. I mean, yep, not market surge, MarketGauge. Excuse me. We're too similar here, Mish. So the MarketGauge indicators down below on TradingView here. Tell me what you're seeing on the U.S. Treasuries again for TLT.
Okay, so basically, I'm fascinated by the long bonds right now. There's an interesting comparison. I had written about this in April after we saw that trough in April. It was very similar to the trough we saw in October of 2022. And if we remember 2022, that's when the Fed was aggressively hiking rates. I mean, the rate of hikes was blinding, and the market couldn't handle it. And as
We
soon
figured
as
out inflation wasn't transitory, right? And so then it
exactly,
was a lot of catch up.
right, and we're still wondering about that, by the way. But we'll get to that in the second part. But what's so fascinating to me about the long bonds is yes, the yields have gone up, but they look like they've stopped going up, so they possibly have peaked. And that kind of happened right around those lows, right? If you're looking at the chart from mid-May. After we saw that April dump, people thought, oh yeah, they're going to stimulate. And then of course they came out and said, no, they're still worried about tariffs. And then you saw yields rise. But it seems to me like the peak is in terms of the yields. What fascinates me about the bonds right now is the conversation that's happening around Jerome Powell. The minutes came out today and we're seeing a divided Fed on maybe we have rate cuts, maybe we don't. The pressure on Powell to resign, which there were rumors today that he might. And of course, the pressure from the president himself, who thinks that we should go down 3 basis points and really get the rates down closer to 1 to 2%, which is where they were, by the way, before we went into COVID. So sometimes that doesn't have to happen. Just the yields fall on the natural tendency of investors to come in and buy the long bonds is enough. And this is what happened in 2022. In 2022, in October, you had, first of all, the gold to silver ratio flip. Gold had been outperforming silver, and then that flipped, and that was the first indication that maybe silver bottomed. Why is that important? Because it's an industrial metal, and of course it is a measure of the economy, and we're going to go more into that later. Number two, you saw the SPY stopped falling, but it didn't exactly take off yet. Right now, that's not happening. It's actually taken off sooner than that. But the bonds, eventually, we did start to see the first rate cut, right? A few months later. And so this is telling. So let's go back to that bond chart that I showed you, because I want to show you something really interesting in terms of a divergence, a very key divergence. So if you look at the first circles, let's get that back up there. Those first circles, this is, first of all, you see a 50-day moving average, that's the blue. The green horizontal line is a 6-month calendar range. That's from January. It's actually about to reset in July. And that's really important because things clear that 6-month calendar range, or if they go up to it and fail it, that's generally a sell signal. But if you go down to the bottom of the circle, that is our real motion indicator. What that does is it measures momentum on a longer term. We also use a 50 and a 200-day moving average. So where you see the circle is when the price was still under the 50, look what was happening to the momentum. It was suggesting that the momentum was getting going, right? Mm-hmm. So that kind of started getting me interested in maybe we've bottomed in the bonds. Not such a popular theory, by the way, because a lot of people still think that the yields are going to go up as inflation goes up. But I think we're setting up for a maybe different scenario. Again, I'll hold that thought. Now let's go to the second set of circles. So we broke down in the last couple of days back under the 50, but look at the momentum. Did it break the 50, which is the same blue line? No, the momentum did not break. So it told you that sell-off was weak at best. Momentum was still suggesting that it had broken out. So now today, look what happened. We got back over the 50-day moving average. So why is this important? We're going to talk about retail. Well, certainly the consumer is looking for lower interest rates, obviously for a lot of reasons, paying off their own debt. Now college kids have to stop paying off their college debts. Again, that's been rescinded from the Biden administration. Mortgages, people have not really done a lot of refinancing at these high rates. The housing market has taken a sputter because of the high interest rates. On and on and on. Obviously, if the rates get lower, it's going to be good for the consumer, number one. Number two is it could goose inflation, and I'll leave that conversation again until we're ready to talk about it. And number three is since U.S. Treasuries are not being bought as enthusiastically as they were by foreign countries, it means basically we're buying back our own debt, and at a lower interest rate that makes it more palatable for us. It may actually help the debt situation. So keep your eyes here.
Okay. And just one thing I wanted to also mention is because in terms of the Fed activity, it seems like a lot of times those cuts have been projected for a while and a lot more than what actually happens in reality. I mean, I remember it seemed like when the projections for the first cuts were going to happen, it just kept on getting pushed out. The futures market would say one thing, and the Fed was saying something completely different. And I feel like that happened again this year, where it was like, oh, we're probably going to have, 7 cuts.
Five
No,
cuts.
probably
7,
3.
right? 5, 7,
5.
right?
And then it's like, okay, now we're going to be lucky to get 1. So it is. I guess are investors, just really kind of off on this projection, or is it the Fed that's kind of off on what they're not acting right? Who's wrong here?
Well, when you talk about a market that's at all-time highs, for the most part, obviously we know that only a small percentage of the market is at all-time highs, but although the breadth has improved, you have to say, was the Fed really wrong in keeping things at status quo on the rates? I mean, it's done pretty well. However, as we mentioned before, the dichotomy between the retail sector and the small caps and the growth sector, that's where you're seeing the stress where the Fed might have done a disservice. And now we're going into that potential stagflation period where the economy stagnates outside of growth, although we know that that will only go on for so long. But the prices continue to go up. And I think that's exactly what the Fed is worried about. And they have to make a choice.
Yeah.
Do they want to spur the economy, or do they want to take the chance and spur inflation, or not spur inflation, I should say? And that is probably, from a monetary policy standpoint, the worst case scenario. Now, there's also a possibility of disinflation, which I know we were going to talk about, but we'll take a look at commodities and then we can decide, are we in disinflation really? Or is it just sort of nuanced? And where does the bonds fit in? And right now what we're saying here is that, to me, whether they actually do something or not, if yields soften here, that will help the consumer and will help commodities. The question is, at what point does that make a big departure from one another?
Well, and I think that's a perfect transition. Why don't we go ahead and start talking about those commodities right now? And I want to just mention, because you say disinflation, and when we were talking yesterday, when I first heard you, I thought you said deflation, which is, again, that's bad.
That's
so I'm
bad.
like, okay, that means bad economy. But when it's disinflation, that's basically the soft landing. That's the goal, right? Where you're still getting prices going up, but not nearly as much. And that's what the Fed has been targeting, right? Let's get back to our 2% target and, bring it down from, what was it, peaking at 9% or something like that?
Exactly,
So,
yeah. And, I'm old enough to remember when inflation in the 70s, late 70s, was rampant. And we have some similarities because it started with an oil shock. Now, we didn't really get the oil shock at the point, but with the Middle Eastern situation that we just got through, that has seemingly gone away for now. We never know, because, it's been a 1,000-year history of conflict. Right. But nonetheless, you have to keep your eye on, we're going to look at oil, but we have to keep an eye on that as well. But getting into the disinflation, right, if you look at certain commodities, they've come off a lot. Food prices have definitely come off in terms of the raw material. I still go to the grocery store and I feel like I'm paying a fortune for things. But I've
Yeah.
also seen prices of certain other things go down a lot. Like fruit,
Yeah.
for example, which was crazy, has come off a lot. But corn and wheat, those prices have come down a lot. But I don't use that as my indicator for inflation, by the way. I look at sugar, but let's start with where is inflation and where is the stagflation part, the potential. Because, we're being detectives right now, you and me, Justin. What we really want to do is put on our Sherlock Holmes hat here and decide the clues.
Right.
Disinflation, stagflation, right? Hyperinflation, we don't even want to go there right now, but maybe that'll be our next conversation. So look at copper. This was the announcement of the tariffs, the 50% tariffs on copper, and it sent copper flying. Now, why was that so crazy to me is because copper is also a huge commodity for AI and data centers. You cannot expand growth stocks and NVIDIA and all these other companies that want to build chips, etc., without copper. So you put tariffs on it. Can you get the copper mines here in time to actually replace the copper? Is it just a negotiating tactic to get the tariffs down in copper? We don't know. The point is copper's already in short supply, and these tariffs are obviously being looked at as inflationary, at least for the copper. And if copper goes up, the theory is if copper goes up and oil goes up, then eventually the silver goes up, and then that's really when you're starting to talk about inflation. So keep your eye on this copper. Today was a little bit of a digestion day. If you look at that same momentum indicator down below, it just flew. So right now, we wouldn't necessarily start to think too bearish in the copper or that this move was a false move, unless we really break down again. I guess under 5 would probably be the psychological number.
Yeah. And that's just, it seems far away, but that's just the low of 2 days ago, right? So.
Exactly. Volatility, that's a whole other conversation we're not going to have today.
Right.
So
and you mentioned sugar.
yeah, let's talk about sugar. So I have a trifecta, right? I call it the trifecta. I love names, right? Modern Family, trifecta, Vanity Trade, and I love to name things because it makes it easy to remember. And so with sugar is part of my trifecta of inflation. So gold to silver ratio is the first part, and we're going to look at both gold and silver. Silver has been outperforming gold, but not to a critical level yet. We'll hold that when we look at the charts. The dollar is the second part. Well, the dollar certainly has been under a lot of pressure, and we're going to look at that next. Sugar, though, more than wheat and corn and soybeans and all the rest, have always been my go-to barometer since 1979. Why? Because sugar is a commodity that really represents stress, social disruption, where people go when they don't know what else to eat and it's the cheaper food that they can get, or they comfort themselves. Certainly poorer economies turn to sugar. And so if you really want to understand if inflation has taken hold in a real sort of cultural way, I guess, or socioeconomic way, then you look at the sugar chart. Now, look, sugar has gone way down, and this is where I was like, disinflation, yay. But now, all of a sudden, look what's happening. Let's go down to that momentum indicator again. Look at that little blue line and that red dot on it. Do you have a cursor that you can put there, or are we just going to
Yeah, there we go. Okay, yeah.
Okay. So
I'm trying to do it, but
I know. I'm sorry. I should have put my circle there. But
no, it's okay.
look at that. What is that showing you? That the momentum in sugar is now at the 50. If it clears the 50 and we get 2 price moves above the 50-day moving average, this is sugar futures spot, then that kind of tells you that maybe hold on to your seats a little bit on thinking that inflation has been licked, because then we can start talking more about stagflation again. So this is clue. This is a clue. This is one of our Sherlock Holmes clues.
Right. Yeah. And to your point here, at least on the momentum side as well as the price side, the 50-day averages have really kind of contained this move. It hits its head up against it and then right back down. So this would be a big change in that character.
Absolutely, and it's been under the 50 now for several months. So the longer something's in a bearish phase, when it goes into a recuperation phase, often the stronger the move is.
Mm-hmm. And you already mentioned the dollar to a degree. Again, this one's been, having some struggles. It's a little bit more expensive to travel abroad.
Yes. I knew I should have gone to Europe when the dollar was at 114 against the euro. Yeah. But no, meanwhile, in all seriousness, this not only, you're looking at a daily chart of the dollar euro, and you can see the dollar's been under a lot of pressure. What's interesting on the momentum below is that it does look a little bit oversold. That dotted line is actually a Bollinger Band. And so if it clears back over the Bollinger Band, that could be a little mean reversion trade, and we might see a pop. The question is it a pop or a bottom? My guess it's going to be a pop and not a bottom. Again, there's a lot of pressure on the dollar. A lot of foreign countries are now not buying our dollar. BRICS has certainly been doing its own little threatening dance. And you don't want the dollar to get so strong either, because that will hurt equities. So the question is, at what point does the dollar skids become really concerning for inflation? Right now the dollar is down, but I don't think it gets too scary yet. Mm-hmm. And we could see a little bit of support at these levels. As you can see right here, it might have bottomed a little bit. Unless it breaks back over the 50, the dollar against the euro, though, I'm going to say that rallies probably should be sold, and the dollar's more to the weak side than to the strong side. A lot of people looking for a major rally in the dollar because they just think oversold means it's going to go up. But it didn't go up in the Middle East situation.
Right.
It hasn't gone up with tariffs. I'm not so sure it's really going to go up at this point.
Yeah, and I always like to remind folks that just because something is oversold doesn't mean it can't get oversolder.
Exactly. And the other thing to consider with the dollar too is that your purchasing power is diminished, right?
Yeah.
I mean, that's why the dollar is so important to this equation, is because if the dollar goes down much further, even if inflation stays relatively in check, you still can't afford to buy as much.
Yeah, exactly. Now, of course, the hedge against that is typically been gold, and this certainly did very well, especially as Liberation Day was unfolding. It was a quick recovery and off to highs, breaking out of this really long base here, and now it's gone kind of sideways, but it hasn't come down. Just because the market's been going up and this hasn't come down in a big way. Mm-hmm. But what is this telling you?
Well, again, let's start with the momentum, because the momentum is so interesting. The momentum actually started to get negative. Yeah, it started to break down under the 50, but it kept holding the 200. And that's when we knew maybe the rally still had some legs. But then more recently, the momentum is now broken down under both the 200 and the 50, while the price is sitting on the 50 and well above the 200. So you've got to think that the momentum has shifted in gold. Now, does that mean I'm bearish gold? No. But it does mean that it could actually come down a little bit more in price. I think if we can get anywhere near 3,200, that would be an interesting place. I wouldn't necessarily be a buyer here unless we really start to see that momentum come back. But gold is only one part of the equation. Let's look at silver. I think silver is far more interesting. So looking at the same momentum actually is having a golden cross. We use the same golden cross, by the way, where the 50 crosses over the 200, right? Mm-hmm. Momentum is above it. And if you look at the price, of course, that's well over the 50 and the 200. So why is this important? Because silver, by the way, is an industrial metal, right? It's used as a conductor. It's used in AI and data centers. It doesn't have the same uses as certain things like copper, but it certainly has a use. And I've done a lot of research on cobalt, because cobalt is absolutely essential for lithium batteries. Mm-hmm. And people have been asking me if silver can be a replacement for that. And the answer is no. But silver still is important to the lithium process. So this is in short supply, apparently. It's outperforming now in terms of the ratio from its peak, but still hasn't really broken down as much as one could think. And so I think you need to keep your eye here. It's flirted with this $37 a few times now, but it's just going sideways. And if this thing starts getting a leg up Silver's been buy it when it looks terrible, sell it when it looks great. When that flips and buyers just keep buying it and it goes sort of more parabolic. I always like to use cocoa as the great example, when cocoa just kept going up and up and up. That's what a commodity can do. It's not an investment, it's a trade.
Yeah.
Watch silver for that.
Now, we were talking before the show, and I missed adding to my IBIT position. It was a really strong kind of end to the day. But where does crypto fall into all of this for you? It's a newer member of looking at that macro space, but how does it fit for you?
Well, first of all, the headlines over this whole year have been incredible. I mean, we had the halving last year, and then nothing really much happened. And then we came.
Well, and the ETFs coming out, getting
right.
approved,
The ETF. Oh my God, there was so many. I actually decided to keep this open. The news. I mean, Jack Dorsey's BitChat. Lets users send Bitcoin without internet access. I mean, that's amazing. The whole stablecoin with the IPO of Circle is the idea that people don't actually have to buy Bitcoin, but they can use it almost like a credit card, which makes it absolutely huge in terms of mass adoption. You know, Bit Digital moved entire 200 million treasury into Ethereum. Stablecoin legislation could be done by mid-July, so we have the government on board. You know, all of this is really amazing. Chainlink, what we're looking at right now, is a very interesting crypto altcoin, because basically what it is a bridge. It's a link between information that's not on the blockchain and the blockchain. It bridges, it gives access to information that you cannot ordinarily get on the blockchain. So this is a future. A lot of young people have told me, keep your eye on this even more than anything else, because this thing could explode at some point. You and I talked about it. Oh, I'm sorry, excuse me. Let me just take a sip of water here. But today, it cleared back over the 50. The momentum is looking kind of interesting, although still not enough. That tells me that this has a lot of upside. And we had that beautiful double bottom. If you look at the April low and then the June low, they were very similar. So now that we're back over 14 in Chainlink, if we can stay above here, I see no reason why this thing can't start making a nice move up.
And then, you know, related, you know, Ethereum, of course, has been, as you mentioned, in the news a little bit. What's your take here?
Well, this was another one when it started to cross over the 50, and I love these moving averages. I mean, one of the things that we do at MarketGauge is the idea of phases, and if I can do some quick little plug of my book, Plant Your Money Tree: A Guide to Growing Your Wealth, is about phases. That's exactly what it's about. I use it on a weekly basis, but it's the same thing, 50 or 200 weekly. This is a 50 and a 200-day moving average. The most explosive moves happen at phase changes. It's the basis of our real motion indicator too. We're using the 50 and the 200, very important, right? One's measuring about a year, one's measuring at about 4 years. You know, business cycles tend to run a little longer than that. But we could see what was happening here. This thing, when the market collapsed, really did not collapse as much. I mean, it went down, but it still came back pretty quickly. Bitcoin did even better, and we're going to look at that. And now here we are. What we needed was some cash inflow, and that's exactly what we've gotten. And hey, is it any great surprise that it happened right at the moving averages? So 2550 was a huge breakout. You know, 3,000 has been a level of resistance. This move today was awesome. Look at that momentum, a nice little gap up in momentum. So now we're going to look for some follow through.
Yeah, perfect. And then you also, just to kind of round out the commodity discussion, and then we'll get to maybe some thematic ideas, some individual stocks that you may be looking at, but maybe we end the commodities with crude. As you mentioned, there was a lot of like, okay, what's going to go on here with everything happening in Iran and you know, straits being kind of shut down and all of that. Do you think there's anything to do here, or is this still too much whippiness to give a clear picture?
Well, when this crossed the 50-day moving average, when everybody was coming out and talking about $40, a barrel. That was going to be the target, and there's all this oil around. What they were ignoring, that we went through 7 weeks of the rig counts going down. And finally this week, the rig count went up. And I think we added, after taking out 10 million barrels from the strategic reserves, we added 200,000, which is nothing compared to 10 million. Mm-hmm. And there are people who are saying that, yeah, there's actually, OPEC Plus is going to unleash all this supply, and that's going to bring it down. But the truth of the matter is that demand has actually been rising. Economically, you want to see demand rise anyway. That's a signal. I mean, if crude gets crashed, that's kind of recessionary. It's not really, it's good for like a nanosecond because people go, oh, cheap gas. But it also, right. So, but it's got other issues. Producers do not want to drill or build more refineries with cheap oil. It doesn't pay them. And a lot of these oil companies have really gotten hurt with their profits. So that's all the reasons why I wasn't buying the narrative that crude oil was going to crash, number one. That big move up, of course, that was the Israel-Iran situation, which, of course, you can see the big move down after that. But this weekend, OPEC Plus announced the 511,000 barrels extra that they were going to do. And it didn't really go down. So now look where we are. We're flirting with $68 a barrel. We're flirting with that 200-day moving average. If we go down to momentum, this is momentum. I love this. I get so excited about it. Notice the golden cross, Justin, right below the red dots of the 50 over the 200. So momentum is in a bullish phase. Momentum is in a bullish phase. This is still struggling to get over the 200. So right now, all we have right here is a recuperation phase. Quickly, we had an accumulation phase. Mm-hmm. If we're going to go back over that 200, I don't care what the narrative is. The price dictates the narrative. To me, that means you have a cheap opportunity to get into oil, and you can do it through USO, by the way. You don't have to buy oil futures. And you know right away if you're wrong, if it starts to break down either momentum or if the 200 can't hold, if that 68 level can't hold, get out. But it's very possible we could see $85 a barrel. And then where's our narrative after that?
Right. And to your point, I mean, that does tend to be where now it's like, oh, okay, now this is worth it, right? For a lot of those things. What was the show, the Amazon show with Billy Bob Thornton? I think at one point he, Landman or something like that.
Oh, right. I actually never saw it, but I heard a lot about it. Yeah.
He at one point does say, look, we want it between 70 and 80. That's kind of the sweet spot, and it was interesting to have that on an Amazon show and Billy Bob Thornton talking about it. But I want to shift gears real quick because you also, while the macro ideas and what's happening with the commodities, do give you a lot of these, the sense of where things are at. How do you kind of take that next step? Okay, so now how do I profit? What areas do you look at? Or are you kind of saying this just gives me the comfort that everything's okay, that the sky's not falling, and so now I'll look for the ideas and the themes that make sense and the stocks that are looking at. How is your routine there? And then we can get into some of the ideas that you're looking at right now.
Well, I love themes, and I love themes especially when there's a domino effect of the theme. So just to finish up the discussion on the commodities, you want to talk about opportunity. So if the yields come down and the dollar stays soft and the silver continues to outperform gold, we've got upside in silver. People ask me, is it too late to buy silver? I say no. I mean, certainly I would want to keep it over $35 a barrel at this point. I wouldn't want to sit through a major downturn. But I think you have more upside than downside. Sugar, we just looked at that. There's an ETF, cane. But even if you don't want to buy sugar, and certainly, again, if it breaks out over that 50 like we just saw, you're wrong right away, you get out. People who've never traded commodities have the opportunity to trade commodities through ETFs. They just have to know that it's always a good idea to check the underlying commodity, because that's going to tell you the story. And there's so many ways to look that up. It's pretty easy to find it for free. Copper. I mean, copper right now, if it has any kind of consolidation between that big bar that we just saw from yesterday or 2 days ago, then you know that that's probably going to go higher. So there's a lot of opportunity in commodities. And then, of course, oil. We just talked about that, and you can look at USO. So now I look at what's the domino effect of that. If we're going to have inflation, you want to find things that have pricing power, right? Things that will not pass that cost on to consumers. But you also want to look at this energy need that we have. So solar, I mean, it got banged up after the big beautiful bill came out because of the incentives being taken away. But it doesn't matter. Look what it did today. This is TAN you're looking at.
Yeah.
This thing has, look at that. I mean, this broke out. It barely corrected yesterday, even though some of the stocks like First Solar had a bigger corrected opportunity, because this has taken out a 50-week moving average. You're looking at a daily, but if you look at the 50-week, for the first time since 2023, we just broke a 2-year down cycle in solar. Great opportunities. So take a look at Enphase. That's a big popular one. Take a look at First Solar. Solar Edge. These are probably the 3 major stocks in the solar universe or the ETF. So that's an opportunity. So what else is my domino effect here? You know, nuclear energy has been on the table. It's still a bit away, but uranium has been consolidating now over 35. And that looks to me, if it holds over this 35, as still another opportunity. So you start to see where I go. And then I have to say, well, if all these energy costs are rising and the cost of silver rises and the yields go down, what are the consumers going to spend on? And that's where I say, made in America. That's always a good possibility right now. Things that make things, I'm looking at, if cost to build is so much higher, why isn't 3D printing going to make a comeback? I love Stratasys. I actually own the stock. Instead of 3D systems, my saying, by the way, for 3D systems, DDD, is that the only thing they seem to be 3D printing is poop, because that stock looks terrible. But this one looks really good. This is Stratasys. They had made a deal with NASCAR. They're an American company with a presence in Israel. They're working on technology now in aerodynamics, all the things that are going to cost a fortune, steel, copper, silver, 3D printed, at some point will get more friendly in terms of price. It still costs a lot of money to do it, but you know that that's going to improve. Okay, so now CC, put up CC. This is another one, because CC fascinates me. So this is Chemours. It's a chemical company. Why is this stock finally moving up? It actually makes, and I forget the name of it, so let's just call it Teflon. It's a Teflon-like coating for all the chips. You cannot have chips operate successfully without this coating. This is not the only company that does this, but this is an American company that does this. And now, if you could see, it's building out of a base. So all these things are fascinating me. I mean, there are other areas to look at, like Zscaler. If you want to look at more of a momentum stock, put up ZS.
And I do have a position in this myself.
Yeah, well, good for you, because this thing looks like it's going to explode. And you know, you have to choose your risk a little more carefully. Obviously, you're not going to be able to use a major moving average at this point, but you can certainly use that 300, that sort of low end of the consolidation there. That thing looks like it's going to, the longer it consolidates at these higher levels, the more explosive it could be going to the upside. So, you know, those are, so I have more in that realm, but I wanted to take a little bit of time to talk about the thin economy, because that's what I'm most excited about, believe it or not.
Right. Yeah. So what is the thin economy to you?
Okay. So we all know that diet drugs have been a big factor, right? We know about Eli Lilly and Novo Nordisk. So I've been watching, they both got smashed. I would be a little bit concerned about both of those companies because they're not American-based companies, and tariffs, we're talking about 200% on pharma, scares me a little bit. But put up VKTX, Viking Therapeutics, VKTX. Okay, this is an American company, right? This is headquartered in California. And what they're doing is they're coming out with a pill form of the diet drug. So why do these diet drugs thrill me so much? Well, first of all, I happen to personally know a lot of people who have suffered with obesity for their whole lives, you know, starting as children, teenagers and on up. Once you get into that, it's very hard. They go yo-yo dieting. They try to go to the gym. They've done every diet you can imagine under the sun, Weight Watchers, Scarsdale, the latest one, keto.
Atkins, keto, right?
And what happens is they lose weight and then they put it all back, right?
Mhm.
So these diet drugs is a game changer for these people. And staggering number of people, by the way, are
Yeah.
obese, not just in the world, but in this country. It's like something like 38%. That's a
Huge.
huge number of the population. So it's expensive to get the Wegovy and the GLP-1s, but they're going to come down in price, I believe. I like this company, like I said, because it's an American company and because they're coming out with a pill form, which would definitely be more affordable. The point is that more and more people, if you see somebody that you knew, 2 months later they've lost 30 pounds, you know why, right? They're on these drugs. And people go, well, long-term use could be dangerous. Well, so is diabetes, so is heart disease, so are all the horrible things that come with obesity. So I don't really think that's a good argument. So now you have to ask, so now you have to ask yourself, what's the domino effect? First of all, this new thin economy, this vanity trade, this new consumer, I have read can make up 6% of the gross domestic product as it catches on for 2026. That's huge. What are they going to buy besides the diet drugs? Okay, so now all of a sudden, imagine yourself, you're thin for the first time. What are you going to do? You're going to feel better about yourself all around. So if you're a woman, you might want to buy more makeup. You might want to buy any beauty product, really. You want to start taking supplements and start to feel healthy. You want to go maybe to the gym. Maybe you want to buy some athletic wear. Maybe you want to start dating for the first time in your life. By the way, Match.com has just made a nice move. So some of the stocks that I've been looking for women oriented have been Ulta. Let's put that up, ULTA. Right? That's made a really nice move off the bottom. And it's beat out a lot of competition, including Amazon and other places where you can get cheap makeup. But women like to go into Ulta, so that would be one. Elf Beauty is having a little trouble getting going, but that's another one, ELF. I like this one because it's more global presence here. It's sort of has cultural diversity, and I think that's a really nice looking bottom. I think you have to have some patience with that one. Let's put up Match, MTCH.com. A lot of people left that for dead, but now look at the basing action there. It looks like it's starting to percolate. Some of these trades may not happen just yet, but I think I'm very excited for the end of 2025, 2026. Here's another one. This one is crazy. SFIX. Just put that one up.
Oh, yeah.
Now, I have to tell you, I was on Fox Business like 4 years ago, right at 2021 during the COVID thing. Look at where it was trading in 2021. And I got asked the question, what do you think of this stock? And I was like, I would never want to order clothes that would come to my house, that I would now be bombarded with things that I would have to put it back in the post to return, because they have a very generous return policy. That was me then. Me now is, I've lost a lot of weight. I don't really want to go shopping because I'm still feeling body shamed. I'm still, maybe my skin is a lot looser. Maybe I may lose more weight. Maybe I put it on. I don't want anybody to see me. Where can I shop? Where I can get some custom clothes? Stitch Fix. Now all of a sudden it makes sense to me. Today it broke out. It got up to about 408. This stock used to trade at 130.
Right.
Right? I mean, so this is kind of where I'm looking. I mean, there's a bunch of others. Planet Fitness, PLNT, that's been getting some benefit. Now you can see it's chopping around, but these are all things I'm looking at going forward as investment. Oh no, there it is. That looks pretty explosive as well. Nike made a big move off the lows. NKE. All these things. So I guess the bottom line is what I'm saying to you is that talk to people who are on the drugs, find out what they're buying, right? Use the old consumer instinct. Watch commercials on TV, as I have been doing. That's how I found out about Stitch Fix, because I hadn't really thought about it. What are they buying? Where are they going? Are they traveling more? Are they doing more, kind of athletic stuff? Are they dating more? Are they buying more? Are they using more beauty products even through cosmetic surgery or like a Botox? I've been watching AbbVie, ABBV, which makes Botox. It's also does a lot of immunity drugs, but that's another one that could be hot. That's, to me, the future in terms of consumerism.
Right. And, as you said, we already kind of saw to a degree, the Novo Nordisk and Eli Lilly big moves from this. And so you're kind of looking at, okay, what's next? It reminds me of the founder of the Investors Business Daily, Bill O'Neill. When jets came out, jet airplanes, it was, okay, what's next? Okay, you had Monogram Industries that was making the toilets for the jet airplanes. Yeah, you got to go to the bathroom when you're doing a 5-hour flight, across the country. You need hotels, from Howard Johnson's to Lowe's to Hilton and so on.
Exactly, the domino effect, right?
Yeah,
Oh, by the way,
yeah.
since you mentioned air travel, GRMN, Garmin technology, they're very big in terms of air travel. The technology on the private planes is amazing. But they also make great trackers for weight loss, how
Yeah.
many steps you've taken. Even though there's Apple Watch and a whole slew of them, this is another stock that has potential based on this whole explosion. Maybe not my first choice, but it certainly looks pretty good.
Yeah. Well, I think, Mish, I'm surprised we got through so much today. I mean, we kind of had a high level of things that we were going to try and shoot through, and I think we covered pretty much everything we talked about. So well done on your part. Thank you so much for the ideas, and thanks as always for coming on. Could you give the book again that you wrote one more time?
Plant Your Money Tree, A Guide to Growing Your Wealth. And if you go to marketgauge.com/book, you can find it there.
Perfect. And so, of course, marketgauge.com, a lot of commentary that you give out and newsletters. And then, of course, people can follow you on X at Market Minute, which is a great place to also get a lot of your content. So thanks for sharing some of that content with us today and our listeners. Really appreciate it, Mish.
Thank you so much. It's so great when I have this amount of time to explain all these things to
Right, as
people.
opposed to the 3
Right,
seconds on
it's a 2-minute
yeah.
bite, yeah. So
Yeah,
thank
right.
you, I appreciate it, and I appreciate your support in having me back
No,
over and over.
absolutely.
Thank you.
Okay, we'll see you next time, Mish.
All right, take care.
Okay, that's going to wrap it up for us this week. Thank you so much for watching. We really appreciate it. And again, don't forget, we're going to be back next week live at 5 p.m. Eastern. And we've got Dan Vanderboord coming back on the show. He, of course, is senior portfolio manager at Revere Asset. I really love some of the ways that he looks at things in terms of looking at the beta, the ATR, and kind of really figuring out, okay, what's going on with my portfolio? What kind of portfolio risk do I have? So I'm sure we're going to dive into some of those things next week. We hope you join us. Thanks for watching this week. We'll see you next time.